if anything, has lost about 3 or 4 rupees from the time that the results actually came through. RupenRajguru is head of equity investments and strategy at Juliusbaer. He's joining us now. Rupen, good afternoon. Good to have you with us here. I was just noticing that you do like chemicals as a space, and you think that that's the space you could buy. It's, in a way, at least for a lot of these names, been completely down and out. Navin Florin, for example, numbers just came out. They were a big miss. Stock barely budged because it's already, it's kind of bombed out. What do you like here in this space, and what would you do?
So, hi, afternoon, Prashant. Chemical as a specialty chemical as a whole, I would say this industry is going through a cyclical slowdown. It's a industry which we believe is a structural industry which is going through a cyclical slowdown. Why do I say structural? Because the big theme out there is that all the Indian companies are working towards import substitution, and they all are gaining will be gaining market share from China, the big China plus one story. So if I were to break up the companies in their life cycle, probably pre-COVID until the run up to the COVID, they had a phenomenal run. There was both margin expansion, PE re-rating, and thereafter in last 2 years, all of these companies have earmarked huge capex. If you see, some of the companies have earmarked capex which is more than the total gross block they have done till date. So what will happen is whenever you do earmark a capex, your ROEs and return ratios tend to come down, and plus also there is a time required to set up the new facilities. So all in all, if I were to just use the old cricketing parlance, they are in that middle overs. So you had the first 15 overs in which you scored big runs. Probably it's a consolidation phase. For next 1 or 2 quarters, I don't think so the earnings will come through, but the stocks, these are the time to pick up these stocks from a 2 to 3 year perspective, because we believe 25 onwards we'll see a huge a momentum both in the top line as well as bottom line. So that's the big thing we are playing.
Got that. By the way, the stock which is reversing now is UPL. It dipped into the red. It's a fresh 52-week low on UPL after the company has lowered the FY24 revenue and EBITDA guidance. They're now looking at a just 1 to 5% top-line growth and the EBITDA growth at 3 to 7%. And Q2 is also going to be subdued for them. It's only in H2 that they are anticipating a recovery. Sonal, you've had a look at the UPL numbers. Take us through the numbers and the commentary and the guidance.
Well, guidance is the most important bit, Reema, and you spoke about it already. But yes, it has come in as a dampener because cutting their revenue growth guidance from 4 to 8% to just half, that's around 1 to 5% from an agrochemical major, definitely talks about how much pressure that we are seeing in the global industry as well. They've cut their FY24 EBITDA guidance as well from 6 to 10% to 3 to 7%, and guidance was something that we were watching out for as well. They say they anticipate demand to remain subdued in Q2 of FY24. However, they expect performance to be sequentially better and to recover completely, or at least to some level from second half of FY24 as well, and that is where they think that things will reverse. As far as why the profit number is lower versus the EBITDA number, that's because there have been one-offs. The company has accounted for a 57 crore rupees loss from a joint venture, and also there is an exceptional item of 19 crore that is a loss versus profit that came in the previous 2 quarters as well. So that is the reason why EBITDA margins are at 17.7%. Profits are much lower than what the street was working with. In terms of their presentation as well, if we talk about what the growth has looked like across regions, in Latin America it's down 15%, in North America it's down 56%, in Europe it's down 19%, rest of the world is down 10%. That's UPL Corporation. Now they've started giving their numbers in terms of segments as well. But yes, they say there's significant decline in herbicide volume and prices and product bans in Europe, and that is something which will continue to impact for next couple of quarters. Some recovery is what they're expecting only in the second half. They do say demand at the grower level continues to be strong and channel inventory is normalizing, but that will only be seen from the second half of FY24. In the first half, they will continue to see some pressure, and that's the reason some impact on the stock as well.
Okay, got that. A lot of volatility on the UPL stock there. Thank you, Sonal. Lots of inputs coming in. The big headline being there, the guidance cut for FY24. Rupen, I want to get your view on financials. I believe that you like some of the larger banks. But my question is more to do with NBFCs and what's the read-through for you as we go through a lot of the earnings. Now, Piramal, Mahindra & Mahindra Financial have been slightly disappointing. Bajaj Finance, the growth was very good, but I think there's a question mark on how much can they maintain margins. Would you look at NBFCs at all right now? And if yes, then which category?
Hi, good afternoon, Surabhi. What we saw last year, financials did pretty well, both from a stock market as well as from a corporate performance perspective, and that momentum continues. And what we have seen once market got a hint that we are through or we are done with the rate hike cycle, we have clearly seen big amount of momentum, not only in NBFCs but also in MFIs and others. So NBFC as a space, typically in an environment like this, they will do well. And we have seen, while there are some aberrations here and there, but at an aggregate level, entire financial pack, including NBFCs, have done pretty well. But markets are always forward-looking, and the movement is always fast and furious. So at this juncture, the reason why we like the big four banks is because if you see this year, majority of them have been a relative underperformer. And now when market are at its all-time high and the overall valuation of market is probably one standard deviation above its long-term average, financials, if I were to look through, on an average, the price to book of the top 4, top 5 bank is actually below its 10-year average. The reason being their performance have been phenomenal. And here in this cycle, we believe probably a few quarters still the earnings momentum will be there. So while NBFCs will also do well, but at this juncture, we would prefer large financials or the big four financials vis-a-vis NBFCs.
Rupen, would you be kind enough to share the QSR name that you like? Is it Jubilant Food? I mean, just kind of talk to us about not whether one should buy or not, but why you like that name, with the name.
Prashant, I would refrain from naming any company. But here again, it's you see, what is the big story from an India perspective? Consumption is a big story. Currently, what's ailing consumption and more so the rural consumption, that's impacting all the companies which have reasonably good presence out there. Again, QSR as a space, we saw COVID time again a massive built up. They all built up their overall tech network and they did phenomenally well. And again, some of these, because the high inflationary environment is there and the middle level consumption is getting impacted. I would not call QSR as a low level consumption or at the premium level, but at the mid segment they have got impacted. But as a big story from an India perspective, the big theme wherein if our per capita income is going to double over next 3 to 4 years, the discretionary spend is going to go up, and QSR as a segment will be a natural beneficiary out of it. I think the leader there has been a relative underperformer, and we believe that the leader has built other adjacencies, and we believe some of the other segments in which they are already there, they probably can easily scale up. They can use the same rule book as the way they did for their main franchise, and I think they can build a really big good line of business from the other franchise as well. So net I would say we like the leader out there. That leader has been a relative underperformer, but we believe next 2-3 years should be good for them.
Okay, that's QSR. Let me turn the focus to the exact opposite. I'm talking old economy, large industrial / capex kind of plays. Would you be looking at this side of the market? Any selection, any choices here? And Rupen, if you could throw in a word on power. I don't know if that's an area of interest for you, but suddenly it seems as people are looking for ideas, and that explains what's going on with the Power Grid, NTPC, and some of the others.
Yes, Surabhi, you are absolutely right. Power was a name which everybody had forgotten till 2 years back, or rather 1.5 years back, and suddenly it's come back into vogue. But if you see, some of the utilities earlier, probably during COVID time, they got impacted. I think the overall ESG theme was very, very heavy, and I think globally all the companies which are into what you call energy, which are not into renewables, have got impacted. So some of these thermal power utility got significantly derated. Probably they came down to 0.6, 0.7 book. And suddenly, globally, we have seen all these industries which got negatively impacted by ESG has done pretty well because they are solid business, cash throwing, high dividend yield. All these characteristics were always there. But when there are all around, dearth of ideas, we suddenly saw a big gush of, I would say, investor interest into that segment, and that has led to re-rating of all that segment. So power, and plus a market is also enthused by, because all these erstwhile thermal utilities are focusing a lot on the renewable side. So incrementally, all their capacities are coming into that. So that's one. And secondly, from a government perspective, while thrust on renewables is there, but the T&D as a business is something which is, I would say, a non-controversial business. And I think that's where we are seeing good amount of interest. Coming to your original question on CAPEX and industrials, that segment has been the star performer for last 2-3 years, right? Investment as a theme has done really well in the Indian market. The stocks have got significantly re-rated. From here on, I would say the returns of stocks would be probably mimicking the earnings growth, or might be slightly lower than the earnings growth, because the re-rating has been quite significant. And if there is any disappointment, probably we might see a de-rating happening there. So I would say the story is very much there, but from here on, expect returns which would be mimicking the earnings growth, and don't expect that 2x, 3x returns which we have got, because those that re-rating is now behind us.
Rupen, thank you very much for joining in. Need to get into a break. On the other side, we'll get you a few BTST calls from our technical experts. Stay tuned.